And so I want to kind of open up today's show with sort of a question to you guys, because I posted this on Twitter the other day, kind of making a joke, right? Because, and I basically said, so just confirming that we're still on for 8 rate hikes this year. And basically my view is that you've got higher inflation, but like, I think it seems to me almost inevitable that we're going to go into a recession here. I mean, anytime oil prices hit as high as they do, there's a pretty long track record to suggest that starts to bite into the consumer. Again, oil is the lifeblood of the economy. It's an input cost into almost everything in our day-to-day lives. And so that was kind of my view. And obviously central banks, they're going to keep tightening into a recession. So that's the question, because there was a lot of feedback saying this, Steve, you're an idiot. You don't know what you're talking about, and perhaps rightfully so. But I want to take that to you guys, because they're like, basically, this makes a stronger argument. Don't you know that this commodity inflation is going to cause even more inflation? Thus, central banks will do the right thing and raise rates even more than what is currently priced in. So there was a lot of that view, right? Like, don't think about the recession. Central banks are they're going to do what they need to do, which is fight inflation. That's the moral thing to do. And because of the war in Russia and Ukraine, that will create more inflation and thus more tightening. Rich, I want to get your thoughts on that and get your views on that dilemma.
All right, cool. So a couple of things. I laugh when you said, are central banks going to do the right thing? I think, have we learned nothing, people? Central banks do almost never do the right thing. And so this idea that they're going to do the right thing now, starting now, because they, have a come to Jesus moment, I think is laughable at best. A couple of things. I think number one, this is not the quote unquote right kind of inflation that I think central banks can affect with central bank rate hikes, 200 basis, 400 basis points, 1,000. It doesn't matter. If commodity prices continue to get elevated, I mean, they're down today, but if they continue to ratchet higher because of war or because of embargoes and sanctions and all kinds of stuff like that, it's not clear at all that any amount of rate hikes, short of, I guess, totally collapsing demand and just, driving the economy into the ditch, would have any effect on inflation at all. Anyways, that's the first thing. The second thing is, I think, and then the final thing is, I think it's really important to remember what they're trying to do. They're just trying to remove the kind of excess stimulus. And so it's not clear at all that they want to, quote unquote, materially tighten. Even if they do raise by 200 basis points or 2% or whatever, I mean, real rates will almost certainly still be negative. And policy will still be easy. And I think they're very acutely aware that this is sort of the wrong type of inflation to be fighting. I don't know, Keith, if you had a different view on that.
Yeah, sure. So first of all, we got to look at, there are 3 kinds. Inflation comes from 3 different markets or 3 different areas that Rich just introduced. The first one is that demand is really strong. And that's the kind of inflation that central banks, they can control, or at least, try to influence. So by creating an environment where demand will weaken or demand will strengthen, depending on what they want to do with the economy. Then you have inflation that's driven by supply. So if there's too much of stuff on the market, prices are cheaper, and then the opposite. And then the other kind of inflation, of course, is FX related. So let's just say, for example, the US dollar just surged, went up through the roof. Inflation, all else being equal, it declines for the Americans, but it rises for everyone else in the world. So you can always have that situation that's happening. Central banks right now, it's incredibly difficult for them raising rates, trying to affect inflation that's driven by the supply lines being shut down. And then, of course, you look at what else is happening out there around the world. However, though, they have the pressure. They got the social pressure. They have the political pressure right now. They're getting pressure from banks, financial markets, specifically on the front end of the yield curve and overnight funding markets. They're telling them, yeah, you got to raise rates to keep up. So you have all that taking place. And so, Steve, when the people, I think they're being a bit when people are saying central banks, they have to raise rates aggressively 8, 9, 10, 12 times because inflation is surging. I just don't think they're not completely aware of the total picture, because you will get to a point where it will break. So I know we've discussed it here on this show before that we do not expect the Bank of Canada to do, what was it, 7 or 8 rate hikes? I think the number's thrown out there. We've always said, 3, 4, or 5, and then we say they get stopped out. So the way they get stopped out is that some other exogenous event will take place, which causes them to pull back. And right now, it is happening, with what's happening overseas. But so a couple things on inflation right now. People are now no longer talking about the global supply chains being shut down. Like COVID, no one talks about COVID anymore. Like inflation was not created by that. And all of a sudden, inflation wasn't created by central banks having low rates or government spending too much money or commercial banks lending out too much. It's Russia. So you remember the Brady Bunch years ago? He was Marsha. You guys don't know that. Oh boy. Oh dear.
Here comes
You can do
the
better than
story.
that.
Here comes the story.
Yeah. I will tell a story, but I'm not going to use the Brady Bunch as a
Wait, before
story.
you get into the story. Okay, finish this thought.
That's not a story. I'm not using the Brady Bunch.
Okay.
And I'm be very wise with my storytelling. But anyway, right now, like for example, over the last 2 days, I saw this headline from on Bloomberg. Rising gas prices. It's Russia's fault. All the American big newspapers like in Chicago, the Tribune, the Times, over in LA, and even up in the Bay Area, like it's all the gas prices because of Russia, and it's contributed maybe over the last to get it moving, but as we've talked about quite a bit on this show, like this hard left turn towards improving in a reaction to climate policies, that's what's really tipped off the surge in inflation, and then the lockdown economies and all that stuff. But again, this is another case where people have very short memories. They're very focused on now the big bad Russians are causing inflation, and it's not the Russians causing inflation. It's been here before, and it's we are going to get a reaction to it. So the best part about the conversation today that I'm excited about is what the central banks are going to do and what some of them are not going to do. Because I think and next week, guys, we have the Fed coming up, and I think it's going to create a really big moment. Both guys want to whoa here.
What they're going to do versus what they should do. Different things, please. People, reminder. Rich, go ahead.
Well, I think that there's another way of thinking about it, which is why I think you were right to start us on this track. And I think that it's not just the Fed or the Federal Reserve or the Bank of Canada that can tighten monetary policy. If you think about it sort of philosophically, what is tightening? It means the access and creation of money and the price of that money. And there's different things that can affect that price of money. One of the things that we've seen recently over the last few weeks is sort of the front end of the yield curve. So the 2-year bond yield has shot up from, I can't remember, 50 basis points to 160 odd basis points. That's a form of policy or tightening. The other things that affect tightening is a lower price earnings ratio, or another way of describing that is if the equity market tanks 30%, trust me, that'll affect the way people perceive the cost of capital. And it'll affect something called the equity risk premium, of course. Another thing that's another way of tightening is rising input costs, e.g. oil. So that's another way. So if you have a massive increase in oil prices, you can think about that as a way of sort of tightening or sort of gumming up the works of your economy, right? And then the other two ways I think are just simply the dollar. So the dollar rising rapidly, trust me, that quote unquote tightens monetary policy in jurisdictions outside of the US for sure. And then the final way is confidence. If you think that the world is going to end in global nuclear holocaust, then you're not going to be as keen on lending to your neighbor as you were 3 weeks hence. And I think that those are other ways that you can have philosophically tighter policy or monetary policy without having the central bank really do anything at all. And so that's another way of thinking about it. So I think that's just something important to think about.
Yeah, I think that last